Okay, welcome back and welcome to lesson number 2. I hope you can all see my screen. Please make sure that I'm audible enough as well as you can hear me. Sorry about that. Okay, coming back to our lesson, please note that the class is being recorded and the recording will also be provided to you guys. So lesson number 2, Introduction to Business Mathematics. We are continuing where we left off, but this time we are moving to a different concept. So the subject aim and why the subject still remains the same. The aim is to introduce you into the basic concept and principle of finance in media organization. It will provide you with the foundational knowledge of the current terminology and concept in finance. But before that, we need to start by covering the concept of mathematics that we need or that we commonly use in finance, which under this lesson we're gonna be focusing mostly on the addition and subtraction or basic calculation involving both positive and negative number and the mathematics rules that have to be applied, and those mathematical rules also apply in finance as well. So this is the subject. What you need to read again is the subject outline, subject schedule. The book remains the same. What to watch each and every lesson most of the time if it involves mathematical or calculation. Therefore always expect, sorry about this, I'm catching a bit of flu, so my voice is always stuck at sometimes. So this, always expect that there will always be a recording that you will also have to watch before the lesson. So since the slides are provided always before the lesson or always before the coming week, like for this, for example, next week lessons will be uploaded by latest Friday, meaning that you can be able to go and work through them and also view the video that have been uploaded or that you are requested. So with this video, once you have the slide, if you want to actually go to the video, you do not go into slideshow or present mode. You exit the presentation mode, and then what actually happens is that you're gonna press your control on your keyboard, and then you're gonna press this link. You're gonna point towards the link, and then after that it will open the link for you. Sorry about that. So that's all in terms of actually getting to view the recording. So how do you access the link while it's like this? So it's control, and then you just move your cursor, it will give out that pointing finger. Then you can be able to press this, and then it will take you to the YouTube channel video that you're supposed to watch. So what to do, so I'm gonna skip the what to do, so because they remain the same. We've already covered that in lesson 1. So what is the most important thing is the lesson outline of this lesson. So we're gonna start by learning the what are the objective of this lesson, what do we need to achieve by the end of the lesson. Then we're gonna move forward and learn the basic calculation and the BODMAS rule that governs the world of mathematics as well as the finance world, to say this is how we actually get to solve scenarios which involve numbers. Where do we start? If there is a multiplication, if there is a minus, if there is a subtraction within the same line, what do I start by doing? Do I start by multiplying before subtracting, or do I start by subtracting then multiply? So these are the concepts that we'll also be learning here. And then the rule of negatives, to say that when negatives are involved in the adding, basic calculation of adding, subtracting, multiplying, dividing, what actually happens. So we need to also understand the rules of the negative. Then the mental arithmetic. So in terms of the mental arithmetic, we're going to take a look in terms of you as a person having to understand the mental arithmetic table, which is 1 to 12, the 1 times 2, 2 times 2, 3 times 3, 4 times 4, to say that. So why is it important for one to always have that in mind and remember that? Is because of the use of the skill that will be required for you to have that critical thinking skill. Remember, there is a soft skill called critical thinking that is required for one in the work environment, so that you are able to apply calculation without having to use your financial calculator. So the mental arithmetic is there for that, to assist us to be able to estimate, to give numbers, to do calculation without the use of a calculator, because of they're using the arithmetic mental calculation in our system or in our mind. And then we're going to talk about financial information in a media company, and then the accounting equation, and then lastly the classification of accounts. So all of these are going to be using what we call the information that we just did under basic calculation, the BODMAS, the rules of negative, and then we're also going to be applying the same concept that we learned in lesson 1 in terms of performing the accounting equation or financial information in the media company. So previously, lastly, we ended the lesson with approximation, accuracy of approximation, which was on our page 16. So yeah, it was on page 17. I just want to make sure that the page is right. So we ended on page 15 with the accuracy of approximation, where we were doing running off numbers in calculations. So this is just a mini activity that I've just created for you guys. When you're studying, please try to solve this one out. It's asking you to calculate the maximum cost of the new product, which is product A. These were the current cost of the product, but we're told that there could be new possible outcome where the price will increase to 10%, by 5%, by 15%. So you need to calculate the new cost per direct material that will be required for producing the product, the direct labor, which is the cost that we actually pay our employees to produce that product, and then the overhead cost that we actually incur is 15 rand per product, which can also include the electricity usage or the machine usage. So, or the machine usage that we actually get to use to produce the product. So direct overhead relates to costs that are some related to the manufacturing of the product, but those kind of costs, some of them we do not have control over, we would incur them even though we didn't actually produce. So some relate to overheads. So overheads can be split into number of types of items. So, but we're gonna also learn about this as time goes on. So here is a basic calculation in terms of performing approximation or rounding off. To say that calculate the maximum cost, you're going to calculate the maximum cost, the maximum expected cost per unit, which is the total of all the maximum cost that you're going to calculate. And then it says maximum absolute error per unit, so therefore will be the same as this one. Then maximum absolute error for 1000 unit will be your maximum cost per unit multiplied by 1000 units. So you need to calculate this and then get to this. So this is just basic mathematics in terms of adding subtraction. That also include your accuracy in terms of the possibility outcomes. So if you're in a manufacturing in a media company and you're producing banners, you know that you're gonna need your vinyls, you're gonna need a lot of items, including your machines, and then you're gonna be having your employees who are gonna be producing the banner or for advertisement, and then you're gonna have your overhead cost, which will be your electricity bill, your water bill, your cost of maintenance on the machine per product. So all of these will be drafted down to you by accountant, but you also need to understand them. If you are running a small small media industry company, small media company, therefore you also need to understand this so that you can be able to calculate the cost per unit of your product so that you don't get to undercost your product. So this is the importance of understanding the basic concept of mathematics, being able to calculate all these figures. So the learning outcome is that under this unit, You should be able to understand the basic calculation involving positive numbers, the basic calculation involving negative numbers, and then understand and apply the mental arithmetic mean, the mental arithmetic table, and then understand the importance of recording financial information in a media organization. Understand the importance of recording financial information. Okay, this one is repeating. And understand the accounting equation. So basic calculations and rules and the BODMAS rule, it says that from calculating financial transaction to measuring space object, math skills are an important part of everyday life. Improving your basic math skill can help you get a job, perform better in your current position, make your personal life easier to manage. And then also that basic math skills are those that involve making calculation of amount, size, or other measurements, or core concepts like addition, subtraction, multiplication, division provide a foundation for learning and using more advanced math concept. So under this lesson, we are going to learn the basic math skills, how you can improve them, and how having the basic math skill is important. You will later then apply your math skill to solve financial information within the media organization. So basic calculation involving positive numbers. If you can remember our number line from 0 going to our right, it's only our positive numbers, which is our integers, positive integers. And then from 0 going that side, we're going to have our negative integers, which we're going to look at a later stage. And then the most basic rule that you have to be applied when performing calculation in mathematics is what we call the BODMAS rule. So the BODMAS rule represent or can be broken down in terms of its short abbreviation to full, to say the B stand for brackets, to say that when performing a mathematical calculation, if there are information that is within the brackets, therefore you start by solving information within the brackets, and then you move to the orders. The O represent the orders or of, where the of represent multiplication, and then it can either be the square root within that current scenario or equation that you're working with. If your equation include square root, start by solving the square root first, or the to the power, the exponential powers, and therefore after that you can then move forward and do the division and multiplication. So in mathematics, division and multiplication hold the same standard, or they have the same value in terms of calculation. So if you are working in a formula or in an equation where it involves negative and the division and multiplication, you can do this simultaneously and calculate the other one and then the other one simultaneously. And then after that we move to addition, then subtraction. So addition and subtraction, they also reason they're in the same color, they also have got the same worth when you're doing your calculation. So meaning that you will also have to perform them simultaneously during the same time. So we're gonna learn how to perform this during the same time under our activities as we time goes on. So I've also got some activities on the book, they are there, which we're gonna also work on, and then we'll be able to try to solve those kind of activities. And we're gonna also use the calculator that I also have on the PC. Then after that, I believe by the end of this lesson you'll be able to play around with the basic calculation applying the BODMAS rule. So this is the most important rule in mathematics. It doesn't matter if you are dealing with advanced mathematics formula from your, or any mathematic formula that you know of, or equation. You can be dealing with derivatives or whatever equation. If someone just mentioned that to you, just know that the most important principle that that person is applying is the BODMAS rule. You will start by solving what is in the bracket, the orders, if there are square roots, exponential, then the second thing to be solved. Then after that we can then divide what is being divided and multiply what is being multiplied, and then this can also be done simultaneously at the same time, and then we can do the addition and subtraction. So basic calculation in the BODMAS, here it says that to do anything involving maths, you will need to know how to add, subtract, multiply, divide, the basic numbers, and knowing this basic is extremely helpful, especially when dealing with money. So For example, the moment most of us get into a taxi, we always try to avoid to have the front seat because we are trying to avoid to calculate money, because we'll be accepting money people from those sitting behind saying that the price of the taxi is 15 rand, and then you also have to calculate how many seats that this taxi have, and then you also give people change when they're giving you 100 rand, and the taxi fee is 15 rand, and then you have to know that okay, the change of this person, it's actually 85 rand. So this is the most basic math skill that most people lack. That's why we're also afraid to take initiative where there is math involved. So maths plays a huge role. So whenever there is money involved, you will be dealing with this basic calculation, and they tend to become tricky when it comes to simple calculations. So that's why it is important, because finance doesn't work around uh, advanced calculation. We don't have advanced calculation in mathematics except when we're working with time value of money concept, to say that you want to invest, you want to know how much your investment will grow by. So that's when we deal with advanced mathematics. But the rest of finance, it's all basic mathematics, where you just get to subtract, receive, take, pay, collect. So it's all about that. So here we're going to be learning the basic concept that are going to govern that. So just a minute, just to grab a glass of water. So here are some of the BODMAS rule, or some of the things that we need to understand. We're going to work with the addition. For example, if you go out with your two co-workers and you each pay 5 rand each for a 15 rand pizza, so meaning that the mates have to add up to 15 rand, meaning that each will be 5 rand, 5 rand, 5 rand. If a pizza is worth 15 rand and we are three of you and you have to contribute equally, so therefore it will be 15 rand. Another example in terms of subtraction, it says that you and your two co-worker want to share a pizza that is 15 rand. You and one of your two co-worker pay and want to determine how much that the third co-worker owes you. So meaning that you actually get to pay, and one of the co-worker actually pays you 5 rand. So how much is left for that co-worker to still pay you? So it will be 15 rand minus the 5 rand your co-worker pays you. Therefore you'll be left with 5 rand. So meaning that you'll be left with 10 rand, and then after that you then subtract the other one that you actually contributed yourself. Therefore you'll be left with 5 rand. So this 5 plus 5 represent the two, actually represent the 5 rand you contributed and the one that you actually contributed, which is 10 rand, meaning that if the pizza costed 15 rand and you paid 15 rand, meaning that your other co-worker is owing you how much? 5 rand. So meaning that when time comes in, your other co-worker will have to pay you 5 rand. So in terms of multiplication, we can go and say that you and your two co-workers have 5 rand to spend each for a pizza, and want to know what price of pizza you can afford. All three of you can only spend 5 rand. So how much or how much is the pizza price that you can actually get in terms of buying the pizza based on your contribution? So it will be three of you, which is gonna be 3 times the 5 rand you can contribute, meaning that you can only afford a 15 rand pizza. So this is just basic calculation. And then we've got a division to say that you and your two co-workers share a 15 rand pizza for lunch, and each person wants to pay their share. So how much will that share be? So you would use a division figure to figure out the cost, to say that okay, the pizza was 15 rand, it was the three of us, so therefore each person will actually have contributed how much? 5 rand. So these are just the basic things that we do on a daily life that involve money, that sometimes we're not even aware that we're actually applying the basic calculation of maths that we have learned or that we have been taught through our learning life. Sorry about that. So this just shows the importance of mathematics when money is involved. So let's just try to do this activity together, Ruthie, and see if you are following up in terms and you can be able to solve this. So this is a payslip. It's an example of a payslip or a sample of a payslip of Cyril Malema, which the payslip is for 28 February 2023. this is an employee of in one of your media company, you are actually paying the person 19,500. The commission that you actually earned over because of bringing new customer in or bringing new market in of people, you've actually given the person a commission of 1,200. And then the income tax that you have been taxed by SARS is 3,600 67 cent, and then it is also contributing towards the union fee, so that in case if something happens at work or people who bargain for him at his workplace, therefore he gets to pay 60 rand in terms of a contribution to the union fee. And then so under this question I want us to calculate the total income, total deduction, and then his take home pay in terms of his salary. So please just do the calculation on the side and tell me how much do you manage to get in terms of the total income, the total deduction, and then as well as the take home pay based on the information provided. You can send that through the chat section. If you can't send through the chat section, please also note that I've also unmuted you. So if your mic is still giving you challenges, you can use the chat section. Please just tell me how much is the total income, the total deduction, and then the take home pay. So this is our basic salary, and then the commission he earned, and then the income tax, the union fee that he pays. So please just let me know, Ruby, through the chat section or the by unmuting, and then okay, so in terms of the total income, you're saying that the person will actually get to earn. Okay, let me just quickly check my calculator. Even though I can do this without the calculator, but we'll still just need a full calculation proof. So in meaning that here we're going to have 19,500 plus 1,200. So this will give us 20,700, which you are 100% correct. It will be the total income. So all the income that the person receives will be returned under the total income. Then in terms of the deduction, we're going to have 3,600,67 cent plus 60. So meaning that this will be 3,660,67 cent. So one of the most important thing in finance is that you should not just only be able to put the calculation or just only be able to write down the calculation. You should also be able to uh, read out the calculation. Like you have seen the incident that we have currently had with our previous and current president failing to read figures in the public space where they were presenting a speech, and then the way figures written in terms of numerical values like this one to say 3,600, and they were actually failing to actually read this out loud because they are failing to understand the number values, or by that time the number values are not right. So it's also that much important. So this will be the total deduction of 3,660,67, and then the take home pay, we are saying that it will be 17,039 rand, 33 cent. So let's subtract this from the 2,700. Please ignore the minus on my side because it's going to say 20,700 minus 3,660,67 cent. So meaning that his take home pay will actually be 17,039 rand and 33 cent. So this is actually his take home pay. So it is also important to also know how to pronounce these figures than also just only to write them, and also to write down the figures in not only in numerical term but also in what, in words, because sometimes you'll find that you have to actually write these in words and send them in words. So meaning that you also need to be able to write the amount in words. So if you're to write a check, the means the check will be written in words, and then also in numerical terms. So that's the importance of actually understanding and being able to write everything in words and express them and read them out loud. So thank you very much for that. You have managed to score yourself some good marks. If this was an assessment, you would have scored 100%. So moving forward, so the activity that we just performed is all about adding and subtraction. Now we're going to perform an activity of multiplication. So I want you to actually tell me, based on the following scenario, Cyril pays 60 rand per month to the union. So how much money do the union receive from him per year? So I want you to calculate how much money do they receive for him per year. So here we're gonna be working with multiplication. So while we're busy with that, I'm just going to explain another bit of concept of multiplication involving both positive and negative number. So if you are multiplying and one amount is negative and one amount is negative, the final answer will always be negative because the negative it's bigger in terms of what we call the negative is bigger in terms of multiplication and under multiplication than the positive. And where you multiply a negative with a negative, to say minus 1 multiplied by minus 1, this will give us a positive 1. So in terms of negative multiplied by negative, it gives us a positive. So these are some of the rules in terms of the these are other rules in terms of mathematic rules or the BODMAS rules. So normally these rules are found within the negative rules where you're involving numbers within the negative. So you are saying that 60 multiplied by 12 is 720. So this is his total membership. So we're just gonna come and say 12 multiplied by 60, which is his contribution per month, multiplied by 12. So meaning that in a year he contributes 720, which is actually 100% correct. So meaning that we're going to write 120 here, so that this is the total amount of fee that he actually gets to contribute. So this is 720, I mean, not 120. Sorry about my sickness. I know the coughing might be irritating in terms of the lesson. So then we move towards the division. Now we come to the division part to say that now when do we apply division in terms of finance? So here is a scenario saying that the total fees received per month by the union is 3,000 and each member pays 60 rand per contribution. So how many members does the union have? So these are some of the question or some of the mathematic calculation that you have to perform within a finance view. So let's say, for example, you're in a media company. They are saying that the company have generated 100,000 per 25,000 viewers. So now the question will be how much did the company make per view of each and every viewer. So these are some of the things that you'll actually have to know and to be able to calculate. So you need to calculate to say that if one person actually view, this is how much you get to generate from that one person viewing. If 25,000 people view and we generate 100,000, how much did we contribute, how much did we earn per viewer? So you should be able to understand those type of cost. Per transmission, this is the cost that we're incurring and we are transmitting to different channel or we're transferring to this kind of or you're actually producing a certain number of newspapers. So these are the type of these are the type of questions that you get to deal with in terms of finance within the media industry. So you are currently saying that 3,000 divided by 60, it's 50. The union has 50 members. So let's perform that. 3000 divided by 60, that's 50,000. So that's 100% correct, meaning that the union have got 50 members contributing on a monthly basis. So if I was to ask you right now to say, can you please tell me how much will the union be making over the year? Can you calculate how much will the union be making over the year? So if we're to ask if how much was the union making over the year, so that will be 3000 times 12, meaning that we'll then get to say, okay, this is how much the union were actually making over the year. So meaning that the union is actually making 36,000 over the year. So that is 100% correct. So there is a skills that you can use, but because these days life have been made simple, we get to use our financial calculators or our scientific calculator to solve this. But back then, you just go and say 3000 and then say multiplied by 12. So we used to use this kind of skill to actually get to solve to say 12 times 0. So any number multiplied by 0 is 0. Any number divided by 0 is 0. And if you divide 0 by any number, you still get 0. So these are some of the rules that you need to understand. So meaning that 2 times 0, we're going to have 0. And 2 times this, 0. So this is just a skill that I'm showing that uh, we just went taught back then. And then 2 multiplied by 0, then it's still 0. And then 2 multiplied by 3, we're just gonna get 6. So we put the 6 here. My 6 is not visible. And then because this 2 is the first value, so here we're gonna put a 0 because now we're moving to this. Then 1 times 0, then we're gonna have a 0. And then this multiplied by 0, and I have another 0, and then 1 multiplied by 0, another 0, and then 1 multiplied by 3, that's going to be 3. Any number multiplied by 1 is that number, so therefore we can add this, and then 0 plus 0, 0, 0 plus 0, 0, and then 0 plus 0, we're going to have another 0, 6 plus 0, we're going to have a 6, and then 3 plus 0, which is there's nothing on top, so it's going to give us 36,000. So this is just some of the math skills that you need to be able to try to put. But one of this part of the skill of this math is that you're going to learn it through the mental arithmetic table, where you're going to understand 7 times 7, 6 times 6. So as time goes on, I'm also going to show you the skills of how to actually do this math in your mind without having to write them down, and how do you get to simplify a calculation where it includes a how to simplify a calculation in your mind so that it's easier for you to be able to get to put down a final answer as soon as possible. So these are some of the skills that we as finance or accountant gets to apply. So also you as an executive, either being an executive of a media company or a manager or an owner, you also need such skills so that you're able to put estimation over your business in terms of how much money you're going to spend, how much money are you going to make, if you're going to take an order for a customer for this much, or if you're going to perform, or you're going to uh, create a show, how much of that show are you going to generate, and how much of share of profit is going to be divided among the people who actually contributed. So all of these are part of mathematics skills that one needs to understand. So the basic calculation involving negative numbers. So these are the rules of negative numbers. I've also listed them on the next coming slide. So if we're multiplying or dividing, So if the signs are different, there is a plus and a negative, the answer will always be negative. Even if we are dividing, if we are saying 20 divided by negative 5, the final answer will have the negative sign. It doesn't matter if the negative one is on the top or on the bottom. As long as the other amount is negative, therefore we're gonna have a negative, the final figure will be negative. Then if the sign are the same, negative, negative, the answer will become positive. And if they're both positive, the answer will still remain positive. And in terms of addition and subtraction, adding a negative number is the same as subtracting a positive number. So depending on which one is bigger, if the positive number is bigger than the negative number, expect the final answer to be positive. And if the negative number is bigger than the positive number, expect the other number to be negative, the final amount to be negative. So this is the mathematics rules behind the negative numbers. And subtracting negative number against a negative number is the same as actually adding positive number. So if we have got minus 5 minus 3, meaning that we're going to have a minus 8. But if this time we've got a minus multiplied by minus, it's going to be a positive. Therefore, we're going to have 5 plus 3 being 8. So here there is a sort of like a small explanation, which I'm going to fully explain in the next coming slide. So here it says the rule of negative numbers. Negative numbers, here it's just explaining that they can be integers, decimal, or a fraction, or for example, minus 4, minus 15, minus 4 over 5, minus 0.5. So negative numbers can be anything from fraction to decimal to rational numbers. So when the basic operation of addition, subtraction, multiplication, division are performed on negative numbers, they follow a certain set of rules. So these are the same rules as the one I explained previously, but this time they explained in a much better and in a with a clear example. Sorry about that. So it says that the number of two negative number is a negative number. So if you are summing up two negative numbers, so therefore the final amount will give a negative number. To say minus 5 plus minus 1, so therefore we're going to have what? A minus 6. So if you're having two negative sign being added, therefore expect the final, just add the 2 and then put a negative sign. But if the sum of the positive number and a negative number is being done, so therefore the difference between the two numbers and the sign of the bigger absolute value is placed before the result. For example, here we are having a minus 9 plus 3, so therefore the difference between the two, and therefore the final answer will take the one with the biggest value, which is minus 9. So therefore we're going to have a minus 6. So using our financial calculator and scientific calculator, so therefore if you enter minus 9 plus 3, you're going to have a minus 6. And if you are using multiplication, the multiplication of negative numbers and a positive number, the final amount is a negative number. For example, minus 9 times 2, therefore we're going to have a minus 18. It doesn't matter if it was positive 9 and multiplied by negative 2, the final answer will still be minus 18. Then in terms of multiplication of two negative numbers, minus 16 multiplied by minus 3, we're going to have a positive 18. Then while dividing negative numbers, if the sign are the same, the result is a positive number. For example, minus 56 divided by minus 7, this will give us positive 8. The negative and the negative will turn to a positive. But if one is negative, one is positive, therefore the final amount will be negative. So here's an example. There is a summary of all this. This has been coming from your textbook, so you can actually get to take this a look from your textbook, which is on page 23. So you can take in terms of the rules of negative numbers under page 23 on your textbook. And then next, we've got the mental arithmetic. So the mental arithmetic is the table that we use where the table involve a multiplication or square root of numbers from 1 up to 12. 1 squared, 2 squared, 3 squared. Two examples just to say 1 times 1, 2 times 1, 1 times 2, 1 times 3, 1 times 4, 1 times 5, 1 times 6. It's how much. So this is something that we need. The reason it's called mental is because we are supposed to know this by our mind, in our head, and by our hearts. So whenever we're having numbers challenge or we're dealing with numbers, the mental arithmetic comes into existence when any person or when you're working with any numbers anywhere out of nowhere. So your mind automatically gets to use this mental arithmetic table, and then being able to actually get to calculate the value first or what is being required for you to solve. So here it says that successful business executives have one thing in common. They all make quick and accurate decisions often, and such decisions involve numbers. To this effect, a solid understanding of basic arithmetic and the ability to perform mental calculation become paramount. So it is commonly understood that knowing your multiplication table will hold you in a good stead. In particular, 1 to 12 times table are regarded as an essential. So what is the basically mean is what this basically means is you need to be able to multiply any two numbers. Where is the number in the number between 1 and 12? So if someone just ask you to say what is what is 15 times 2, what is 7 times 4, so you need to be able to give that person a number based on the mental arithmetic table. So you need to be having it in your mind. So please just give me 2 seconds just to help myself before I start sneezing. Thank you very much. Back. So let's take a look in terms of example in page 24, which looks similar. This is a summary of what an arithmetic table looks like, and on your textbook it's on page 24. So this should help us to solve a lot of issue or a lot of calculation problem at a simple um, click of our mind. So here we have got 1 times 1 giving us 1, 2 times 2 giving us 4, 3 times 3 giving us 9. So if we can check this order like this is to say 4 times 4 give us 16, 5 times 5 25, 6 times 6 36, 7 times 7 49. So I want to show you the importance of this. So if someone just go and say 7 times 6, because I know that 7 times 7 is equals to 49, and this time I'm saying 7 times 6, it means that I'm left with 1 7 to actually equal to 49. So if I just remove 1 7, if I just remove 7 out of 49, I'll get what? 42. So this is it. Same applies. Instead of actually using 49, if I just say 6 times 7, so you can just actually say, okay, 6 times 6 is actually 36. So if I just add another 6, what will be my answer? Will be what? 42. 6 times 7, 42. So this is just the basic knowledge that one needs to have so that it's easier for us to understand. So how do you practice the mental arithmetic So in your head, you just give yourself a number, but one of the things that you need to understand is the value between 9 times 9, 10 times 10, 11 times 11, 12 times 12. So if you're given any value in between, to say, guys, tell me any multiplication between value of 1 and 12. To say that, okay, I can just say, what is 9 times 6? So that's the first question that will come. Okay, what is 9 times 6? So, okay, how many 6 are there actually? Meaning that, okay, when I'm saying 9 times 6, 9 times 6 is like adding 6 9 times. So if I add 6 to 6, that's 36. So now I have to add another 6. That's 42. I have to add another 6. That's 48. I have to add another 6. That's 54. So you get to see the explanation behind the mental arithmetic. So without even the calculator, as long as you understand, okay, 8 times 9, 8 times 8 is 64. So if I want to go to 8 times 9, meaning that I'm just adding another 1 8, that means that it is going to be 64 plus 8. That means that it's going to be 72. So then you come back to 72. So it's like adding 8 times 8, it's like 8 plus 8 plus 8 plus 8, 8 times. You're adding 8 times, but not because it says times 9. You're adding 8 9 times. So therefore, you can go and say, okay, 8 times 8 is 64, meaning that I'm just left to add 1 8. So therefore, you add that 1 8. Another method is to say, okay, if it was 9 times 9, this means that I'll be having 9. I'll be having 81, but this time I'm subtracting uh, 8 out of there, so therefore I'll be having how much? So therefore you actually get to calculate, and therefore you'll get back to 72. You subtract 1 9, therefore you get back to 72. So that's the arithmetic mean. So before I move forward to the next topic, which is going to be related to finance, do you have got any question in terms of the what we just covered? Do you have any question based on what we just covering? Okay, great. Let's actually start with continue with the lesson, but this time now we're moving forward to recording financial information. So why is it important for one to record financial information? So this is part of compliance within the rules within each and every country have got its own rules in terms of that every company have to record its financial information and for accuracy and safekeeping and to make sure that the company does not get to just operate and then not know whether they're making loss or profit. So therefore recording financial information is vital for the success of the business, knowing where you are and where you are going and being able to track your performance in terms of the business success. So in terms of in terms of the startup of any business, it doesn't matter whether you're starting a media company, you are starting a construction company, you are starting whatever type of business. Each and every business requires capital for it to actually get to begin with. So we have sources of capital. We're gonna start there. So for every business to be started, we need capital. So the first type of capital we can have, this is the first type, equity capital. So equity capital is you yourself taking your own personal money, putting it into the business. So therefore, that's what we call the equity capital or equity ownership capital. So we call it owner's equity. And then if someone comes in, if the company is already into existence, and you want to raise money, you don't have enough money to buy a certain type of asset. What you actually go and do is that you can sell your shares. When you sell your shares, we refer them as equity. So you are selling a stake of your company to someone else, meaning that that company will have a bit of control over what you decide on that business because they have got now a little bit of share in terms of contributing towards the business success. And then the second type is the debt. So instead of you having money to start the business, or if you don't have money, you can actually go and borrow money from the bank and start the business. So so debt capital, it's one of the sources of capital that you can use to start up a business. Even if you already put money from your own pocket as an equity and then find that it's not enough, meaning that you can therefore move forward and go and borrow money and then top up from the capital that you already have and then continue with your business. And then we've got another type of capital funding, which is internal generated funds, which you also refer them as retained earning. So what type of internally generated funds are we referring to? So this can only exist, or you can only use this type of funds only when the company is already existing or already existed for over a year or a month. You open a company using either one of the two capital sources of capital. The company gets to operate. Once the company operate, instead of you taking profit once the company generate profit, you take that profit and reinvest it into the business. So once you take that profit and that is and you are reinvesting it, so we call it internal generated funds, which we call it retained capital, retained profit capital. So it's the profit that you didn't retain and did not take as a part of the share, and then you actually say, I'm gonna reinvest it into the business. So the profit, it is still yours, but now you are saying you are reinvesting it into the business. And then we've got trade credit. Trade credit is the same as borrowing, but this time the moment we say debt, we are referring to a long-term debt, and then the moment we say trade credit, we are referring to a short-term debt. If your company is already into existence, you need some capital to buy some supplies so that you can be able to produce your banners, so you can be able to produce you can be able to actually go and do your performance or run the business. You go and do a short-term loan, so it falls within what we call a trade credit. So this is another type of source of capital. So once you receive all this money in terms of capital, you will still have to record them that I've received capital. But how you record them is something that we're also going to learn once you start understanding the terminology of the accounting equation at a later stage. So what is the importance of recording financial information in a media company? So for a business to be started, capital will be required, and capital will be used to buy assets or what we call resources that the company might need to operate. So that is the first thing that you're going to do under a business. You start a business, you put in capital, that capital will be recorded, and then you go and start buying resources or assets. Assets include things such as the building. You can buy a building, you can buy a vehicle, you can buy your printing machinery, you can buy a transmitter. Sorry, you can buy a broadcast transmitter, which you can be able to use to actually get to fund your what, to actually get to transmit your shows to the viewers, to the public. And then, like any other business in any sector, media company will always require capital and startup assets to operate. For example, media company will spend their capital on assets such as mobile transmitter, vehicle building, like already mentioned. So money is required for a business to operate and generate profit. And when money is involved, number will always be involved. So under this section, we're going to learn how media companies record their financial transaction and resource in their financial records book. So recording of financial information in the media company. So we did mention that the first thing that is going to happen is that capital will be provided within the company by the owner or by you going and borrow as the owner. Once the capital is available, we're going to buy assets. So assets might include transmitters, banner producing machine, studio equipment if it's a radio company, or if it's a broadcasting company, therefore you're going to buy studio equipment. And then you're also going to need employees, so the capital will also be used to pay off employees at first year. Then once the money is involved, so this capital, when it gets in, we're going to record it, and once we record it, we're going to also record that, okay, the money now is going to flow out, we're going to buy the following assets. So this is just the startup and the basic knowledge or theoretical concept. We're going to still go and do the practical one where we get to show how to record that. Then after that, we're going to start the operation. Company will start operating because now we've got assets, we've got workers. We already remember, before you start a business, the first thing is to study the market. Is there a market for your product? If it's a show that you are trying to create, If you are an employee working at a broadcasting company and they ask you to come up with a show, so when you try to come up with a show, their question is, will this show actually have people to watch? Are there people willing or interested in this kind of idea or in this kind of activity? Therefore, you're gonna start your production, shooting the show and everything, and then you're gonna start selling the show to TV or to those channels that you actually sell. If it's a newspaper, start selling to individuals. If you're producing banners, you have customers who come and require a number of banners that you actually get to produce for them, and then selling the product to customer on cash. You will either sell the product on customer on cash or on credit, as well as rendering services depending on what type of service you'll be offering within the media industry. Where if you are a journalist, you just go and do your report on a specific environment and then charge the service that you actually render, to say that I've went to this, I've performed an interview with the client, and then here's the interview. You can use it for your live news later on in the evening when you do the live news. So these are the type of things. So you need to also be able to know, okay, how much am I gonna charge, and then after I charge, how much did it cost you to get there? So if you are talking about the product of the banner, how much did it cost you to produce the banner? How much did you sell it for? The difference therefore becomes your what? Your profit or loss. If your cost exceeds the amount of money you generated, the company actually get to generate a loss. But if your profit that you generated are bigger than your cost, therefore the company gets to generate what? Profit. So the company makes money and pay its workers and tax. And then the remaining balance is the profit or loss, depending on which one was bigger between the income as well as the expenses. So if profit was left, assuming that you make more money to a point that you're able to pay your workers and tax, and then you're able to cover your expenses, and then there is still money left. So that is the profit that is remaining for the company owner. So as the company owner, you can choose to withdraw that money and use it for your own personal use, and then whatever will be remaining there will be used to continue to fund the next coming production. And then we also have got reinvestment. You can reinvest the money, which meaning that you are going to buy new assets, you are going to buy new equipment, or you are going to travel more and try to cover more areas in terms of service rendering that you are service, in terms of the service that you'll actually be rendering to the media company or to any organization, sorry, that you'll actually be performing for. So meaning that the owner either take the share of the remaining profit or reinvest it. Once you reinvest it, meaning that now you are going to try to generate more revenue by reinvesting or by buying new equipment so that you can fund your business. So the purpose of the accounting cycle. So we have got the basic accounting cycle. So the purpose of this basic accounting cycle is that for each and every transaction, there will be an opening balance, which is going to be performed in a permanent account, and then that transaction during that period will be recorded, and therefore we're gonna have an end period adjustment. If there are any adjustments that have not been recorded, we're gonna record them, and then after that we prepare our financial statement. From financial statement, we close off the books. So the purpose of accounting is that it's systematic recording. We communicate the financial status, it communicate the financial status of the business, assist in decision making to say, is my business making profit? Should I continue producing this product? Is this product being profitable? Why am I paying too much for this kind of assets, whereas this other supplier is saying is paying this much? So it assists with that. It ensures a control of assets to say that, am I utilizing these assets very well? Is this assets that I've bought being making me profitable, or should I destroy or should I sell the assets? Plan future activity to say that what needs to be done in the future for me to be able to generate revenue, as well as to comply with the laws within the country to say that each and every company have to pay tax, and therefore the company tax will be calculated based on the profit generated, meaning that you will need to record each and every transaction that you actually get to perform so that you can comply with the companies or with the law within that specific country that your business is operating with. So coming to just one more minute and I'll be back. Sorry about that. So we did manage to explain in terms of the terminology on how the business gets to be started up and how the business gets to start operating and then generate profit or either losses. If profit, then owner gets either to withdraw or reinvest the money. But all under this process, there is something that have to actually get to occur for the company to be able to actually determine whether it's making profit or not. So the first terminology or the first important concept that we're going to cover VFS today is the accounting equation. So the accounting equation. So what do we need to understand about the accounting equation? So it says that the accounting equation states that the company's total assets are equal to the sum of its liability and its shareholders' equity. This is a straightforward relationship between the assets, liability, equity, and is considered to be the foundation of the double entry accounting system. So the main framework of the accounting is based on this equation, and the equation can be expressed as follows: assets it's equals to owner's equity plus liability. So before we move forward, I'm going to explain why assets is equals to owner's equity plus liability. So as the owner of the business, you will invest money, and once you invest money, that money we said that you are going to buy assets. So the money that is invested will be equal to the same amount that is being used to buy what? The assets of the company. So far we have got assets being equals to what? Owner's equity. And as time goes on, as the company operates, you will find that you do not have enough money to contribute to the business if something is needed. So you'll actually go and do what? And borrow. So when you go and borrow, you're gonna still use the same money to buy company assets or resources. Meaning that now the amount that you invested plus the money that you borrowed will be equal to the what? So it will be equal to the assets that you actually get to buy or invest into. So therefore assets will be equals to owner's equity plus liability. On top of that, once the company generate profit, the profit that the company will generate will become the owner's what? Will fall within owner's equity because the profit is of the owner of the company. So therefore the profit generated by the assets of the company will be equals to what? The owner's equity, because that's what the owners also will receive. So here it says that assets represent the value of resources controlled by the company and the liability represent their obligation. So and then both liabilities on owner's equity represent how the assets of the company are financed. So we only borrow to finance the assets, and the owner also contribute to finance the assets of the company. So included in the owner equity are company income and expenses. So we include them under owner's equity because at the end, the difference between the income that was generated and the expenses that was incurred will become the profit, and which that profit becomes what? Of the owner of the company. So here it says that every transaction that is recorded in the company financial record book of accounts will have a balance effect on the accounting equation. So meaning that if we went and invest money into the business, we're gonna write that amount under the owner secret that the owner invested this one. We're gonna record it, and then we're also gonna record how much of that money was used to buy the assets. So meaning that we're gonna have assets always being equals to owner's equity plus liability, even there's no debt. So meaning this will be zero, but the amount invested here by the owner will also be the amount that the business actually invest into assets. And then it continue say that all transactions build up to create a financial statement called what? The statement of financial position. So the statement of financial position, which is nothing else but a giant accounting equation. So I don't have a picture yet of the accounting of the statement of financial position in this slide, but in the next lesson, which is lesson 3, we're gonna also be talking about the statement of financial position, and then I'll be able to show you in terms of how big the accounting equation is. So here it says that there are three main elements in the financial position statement, namely assets, liabilities, and owner's equity. So the accounting equation that we actually perform leads to the statement of financial position. So statement of financial position is another way of actually the accounting equation of the company. So in the next slides, we learn each element and the accounts that falls within the each element, which is the accounting equation. So on your textbook, page 26, there is example 1F, which also show the classification of accounts. So this is not an account per se, but it's an element of the accounting equation, and then we can refer it as a big account. But later on, there are what we call a classification of account, where classification of account we are talking about types of assets that we can say this is an asset of a company. So here it says that assets are valuable resources that are owned by the company or a firm. They represent probable future economic benefit and arises as a result of past transaction or events. So an event have to occur for us to actually have what we call something called an asset. So an example of an asset include cash. So if investor invested cash in the business, we're gonna say that okay, we have got now cash in the bank of the business have got cash in the bank account, so that is an asset. These assets can be used for future economic benefits, so therefore it qualifies it as an asset. Then accounts receivable, when you sell your product in credit, so therefore those people, we call them account receivable. You are still to receive the amount of money that you actually sold on credit. So if you sell an item on credit, you're gonna have an account receivable, meaning that this is still the cash you are still to receive. So therefore it's gonna be future. This means that it's a probable future economic benefit, so it falls within an asset. So these are people that you will say that you have entered into contract with. They are going to buy on credit, and therefore they're gonna pay later. And then we have got inventory. So inventory relate to your stock. You're gonna stock some items and then sell them, or you're gonna stock resources, raw material. The raw material will be the one that you turn into product, and then from there you sell them, so they will fall within the inventory. So once you buy them, you know that once you get this type of asset or raw material, you're going to convert them into product and generate revenue, which is probable future economic benefits. So and prepaid expense. So prepaid expense, if you're running a company and then you pay your insurance in advance, you pay them in advance, meaning that your insurance now actually owes you money for services that they haven't yet rendered to you. So meaning that that amount, it's a cash that is still due to you until the service is rendered. Therefore you're gonna write it in the assets. And then investment as itself, we already know that it's gonna lead to possible future economic benefits. And then land and building, we use the land and building to perform or to operate our business. So these are type of assets that we can have. Equipment and goodwill. Goodwill, mostly we found it in patents. If you own patents or trademarks, you're gonna incur what we call goodwill in terms of appreciation of the value of those assets. So it continued to say that assets can further be categorized into two groups, where we're gonna have your current assets. These are assets that can be disposed or used within a year. So, or in a simplest term, is to say that current assets are assets that can actually be converted into cash within a year, inclusive of cash. Inventory, it's one of the current assets. We buy inventory so that we can actually sell it within a year. So meaning that it falls within current assets. Account receivable, once we sell our goods on credit, we do not expect these guys to take number of years to pay us back. They will have to pay us within a year. So that's what can be classified as a current asset. And then non-current assets, these are assets that are kept for over and above a year, being used and before disposing them. So when we refer to current assets, we're talking about type of assets that once you own them, you buy them or you own them for future economic benefits, but not for only just over a year, not only just for a year, but over a year. For example, you purchase land and building for over a year, equipments to be used for number of years. So this is what therefore classified as non-current assets. So classification of accounts. So these all types of assets that we are seeing here therefore becomes accounts within each and every category. Current assets. We're gonna have a cash account, which is gonna be the bank account. We're gonna have account receivable, which is another account for people who are owing us. We're gonna have an inventory account, which is our stock. Prepaid insurance, if we actually pay our insurance in advance. If the company actually invests into other companies, therefore, or invest into some small investment in the bank so that they can also be generating money from their money that is sitting in the bank. So therefore, this will also be classified as within current assets, depending on the type of investment that they actually took. If it's an over 3 year investment, therefore we're gonna fall within non-current assets. The non-current assets at accounts will have land, building, property, plant and equipment, goodwill. If the company invests into another company or buys another company, that will also fall within non-current assets. So these are type of classification of accounts within non-current asset and current assets, and the element of assets within the accounting equation. And then we also have got liabilities. So here it says that liabilities represent obligation of the firm, and they are probable future sacrifice of economic benefits which arises from the result of past transaction or events. Example of liabilities include notes payable or loan payables. If a company goes and borrow money, so it's borrowing money to actually get to buy assets, which they will still have to pay back the loan and interest, which is a sacrifice of economic benefits to assets which will generate profit. And then also I've got account payables. Account payable, this is our short-term credit, our credit card. If the company have got credit from the supplier, so we call them account payable. Salaries and wages payable, the employees' salaries and wages also fall within liabilities. Interest payable, interest that we have to pay from the loans that we actually took or from the short credit that we actually took to purchase our stationary assets. And then income tax payable, which is the one that is due to SARS, also fall within the liability because we still have to pay income tax if we generate any profit. So same like the assets, current liabilities as an element of accounting equation can also be classified into two categories or be divided into two categories. Current liabilities, meaning that these are liabilities that can be paid within a year. We refer them as short-term debt. Things such as account payable. When you buy something from your supplier on credit, you are expected to repay that within a year. So meaning that this will be classified as an account within current liabilities. Salaries and wages, you pay your employees on a monthly basis, so therefore will fall within, or will be, this account will be classified within your current liabilities. Interest payables, also they have to be payable within the year, so therefore will be classified under the current liabilities. And therefore we have got non-current assets. These are liabilities that are paid over years, the long-term debts. If you take a loan, that loan balance will be represented in your non-current assets because it will have to be paid over a number of years. So there is another type of debts that are there, but I won't be able to explain them now because the terminology will be very long and I'll have to explain the longest explanation to explain what type of a debt is it. So some of you might be aware of it from the movies called Debentures and Notes. You can research about that and see how they actually work. So these are another type of liabilities that the company can go into. So they are classified within the non-current assets as long-term debt. So an example is given on your textbook as well. We've got mortgage loan where you get to buy a property, a house, and we've got the long-term loan where you just took actually to invest into the business. And the last element of accounting equation is our owner's equity. So the owner's equity represents the owner's residual interest into the assets of the business and resides and residual interest in another name of for owner's equity. So it can be the amount remaining after the liabilities are deducted from the assets. So if we go and say assets minus liability, and then we still have got something remaining, which is going to be positive. This means that whatever is remaining that is positive is of the owner. For example, if let's say you want to start a business, you do not have money right now, you go and borrow 100,000 to start a business. You go and buy assets that are worth 100,000. Remember, assets can be stock, other equipments that you're gonna be using for your business, including rental, everything. And then your assets start to grow. When you generate money, you buy other assets with the money that you generated. So if we go and take a look in terms of how much you still owe and how much now your assets are worth, when we subtract, whatever difference that we're gonna get there, it's gonna be remaining to you because at the end you still have to pay your debts, which is your liabilities, and therefore whatever will be remaining after you pay them off will be what belonging to you instead of the people that you actually owe. So here it says that owner's equity also reports the amount invested in the company by the owner plus the cumulative net income of the company that has not been withdrawn or distributed to the owners. For example, if your company already generated profit and you do not actually take that profit out, you don't withdraw the profit, you just reinvest it. So that profit, it is still yours, so it will still be shown within the account, the owner's equity account. And therefore if you withdraw, therefore we're going to also represent that the owner actually get to withdraw, so we call it a withdrawal account. So therefore we're going to say, okay, actually withdraw this much from the profit of the company or from the money of the company. And if you put it capital, we're going to have a capital account to say that, okay, the owner had more capital in the business, this is how much, and therefore that amount is now sitting in the bank on the asset side, meaning that now our assets will be equals to owner's equity. So here it says that under the accounting equation, both liabilities and owner's equity represent the claims on the asset business. Liability are claims by external people to the business, and owner's equity is claimed by the owners. So meaning that whatever assets that the company owns, someone have got more interest or claim on those depending on who actually contributed. If it is you first who contributed through only equity capital, where you contributed your money from your personal account to the business to start the business, meaning that you have got more claim on the assets of the business than any other person. But if you actually go and use debt to fund your business, it means that the people that you borrowed from have got claim to your what? to your assets of the company until you pay them off. Therefore, that's when you can say that you are the only person who have got claim on the assets of the business. So that's why we say that owner's equity plus liability must be equal to what? To the assets. So what are the transaction effects on the accounting equation when we perform a transaction? So let's say an activity took place, will be the effect? So if a transaction is performed or the owner deposited money into the account, so this is what actually might happen. It may increase both the asset side and the liability side and the owner's equity side. Or it may decrease both the asset side and the liability side and owner's equity side. What will be the activity on the first one? To say that what will increase both the asset side and the liability side and owner's equity side. The example here will be the owner. I'll just use the if the owner deposited money into the business from his personal account. So that will be capital contribution, meaning that the owner's equity will go up. So then I have the owner's equity going up. The bank account, which is the asset side, will actually go up, which is the cash account, will actually go up. The liability will remain zero. So meaning that our assets will be equals to the liability plus owner's equity. So therefore our accounting equation actually balance. And what might decrease both the asset side and the liability and the owner's equity? So now we have to think of something that might decrease both of these. So let me try to think of an accounting equation that might decrease both of these. Okay, I think I've managed to get one. So assuming that from the amount that we have in our cash account or bank account, we took some fee from our assets, which is our bank account, and we pay our liabilities. So meaning that our assets will decrease because we took some account from our asset side to pay our liabilities, meaning that also our liabilities will also decrease, and then our owner's equity won't be affected, will be zero, meaning that under this case our assets will still be equal to the owner's equity plus liability, because now the liability have decreased, also the assets have decreased. So they must, if there is a decrease on one side, they also have to be decreased on the other side. But in some scenarios, only one side can decrease and increase at the same time. So like here, it says that it may cause both an increase and decrease on the asset side. So one transaction can cause an increase or decrease on the asset side. For example, we go and take money in the bank account, so that's a decrease. We go and buy a vehicle for the business, meaning that now we've got increase in the company vehicle account. So we're going to show that we have a vehicle of this much, so our vehicle account will increase, but our bank account will decrease. So meaning that the plus here and the minus here on the same asset side will actually give a zero balance, which will be the same as the one on the liability and owner's equity side, which is gonna be zero. So here it says that sometimes it may cause both an increase and decrease on the liabilities and owner equity side. Like here I'll just try to make an example to say that one that will affect both the two is that we use profit that we generated over the year to pay liabilities. So meaning that our owner's equity, no, that one will affect actually our bank account as well, because that will have already been recorded in our bank account. So I'm still trying to think of one that will increase and decrease both the liabilities and owner's equity. So sometimes what actually happen is that you might take what we call a short-term loan to pay the interest of the long-term loan. So that is an increase in liability and a decrease in liability as well at the same time, if the company didn't actually get to make money. So you can use the company's credit card or the company credit to actually go and borrow a short amount to pay off the interest of the bigger loan, and therefore pay off that other one at the later stage. Sorry. So that means that that will lead to a both increase and decrease within the liability, decreasing the expenses of the what, of the bigger loan, of the long-term loan, and then for increasing the increasing the short-term loan. So here it says that regardless of what transaction occur, the accounting equation must be in balance after the transaction is analyzed. So the analyzing of the accounting equation is what we're gonna be covering in our next lesson, which is lesson number 3 by next week. So one thing that I actually want us to do is try to understand more in terms of the accounting equation. So what we are saying here in terms of the accounting equation, I'm just gonna go back to the accounting equation formula. Sorry about that. I think my sickness is actually growing while I thought it was becoming better. Okay, here we are. So this accounting equation is the one that plays a huge role in terms of okay, my laptop is currently freezing a bit. Okay, it went way too far. So, do you have got any question, Ruby, in terms of everything that we just covered here so far, especially the accounting equation? This is the main startup for finance. Anything that you have to say that have to deal with accounting, finance, cost accounting, they all play around what we call the accounting equation. So under this lesson, normally we've been covered the performing the transaction. Okay, here we are. It just keeps. So in terms of the accounting equation, the most important part that under this lesson that I want us to focus on, it's on page 26 on your textbook. If you have got the textbook, which is classification of accounts. So if I didn't mention assets equals to owner's equity plus liabilities, so we can actually get to play around with this equation to say that if I go and say assets minus liabilities, I will actually be left with owner's equity. So this is making one item subject of the formula. And then another thing again is that if I go and say assets minus owner's equity, which means that whatever will be remaining will be what for liability, meaning that there will be a liability claim towards the assets of the business. So in terms of page 26, there are classification of accounts that are there, so which I'm going to try to explain them. So in terms of the owner's equity, which I'll start with, we've got drawings. Drawing is one of the account where the owner of the business gets to withdraw some money from the business. It can either be the profit that have been generated or revenue. And then also have got the capital. Capital is the amount that the owner actually invests. This is one of the account within the owner's equity. And then we've got the expenses. Expenses of the business of the company include both the cost of sales, which is the goods sold to actually get to generate revenue, interest expenses, interest on loan, credit losses, salaries and wages, maintenance and repair and maintenance on the assets of the company, advertising cost, postage, telephone cost, fuel for the vehicle, stationery and other office consumable that we might buy for the office to use to generate revenue. So this will all fall within expense, and they are all classified as account within the owner security, but under what? Expenses. And then in terms of the income, income refers to the profit that the company, or the income that the company have actually generated. Selling of assets, which is of the stock. If we sell our stock or inventory and generate revenue, so that will fall within our sales account. Rent income, if we have got a property that we bought under our business and we're renting it out, so any rental income will be considered an income, therefore will be classified as a rent income account. It will fall within the rent income account. Interest income account will be created if we invested money and we're earning interest over that money. So therefore we're going to have a new classified account called interest income. Credit losses recovered, commission received if we have received commission based on the number of sales that we generated. And then under the assets, I've mentioned that we've got two categories that we've classified: the non-current assets, where we've got the land and building, and non-current assets, where I mentioned that these are type of long-term assets that the company invests into, and they won't be able to convert these kind of assets into cash anytime soon, and they are not planning to actually dispose these assets within a year, but they will dispose them over a number of years. So we've got land and building as number one, machinery that we're going to be using to produce our product or our banners, then other equipment that we'll buy to actually supplement our machinery to use on our machinery, the furniture that we're gonna use in our offices, vehicle, fixed deposit that we're gonna deposit in our that we're gonna invest in the bank over the long term so that we can be earning interest on the business account. So all of this will fall and will be classified as account within the non-current assets category of the assets of the company. And then we also have got another category called current assets, which falls within the element of the assets under the accounting equation. So under this one, we're going to have things such as your trading inventory account, where this will all be the stock that you actually get to hold within your company, including the raw material that you're going to need to produce your product. Trade receivable, these are people that you sell, that you allow to buy on credit that are going to pay you back. Savings account, saving account are those type of account that you can access and take the money within the year or within a period of a day. So all of these will also be classified as a current assets. Remember, our current assets are type of assets that can be converted or disposed into or converted into cash or disposed within a year. Then petty cash as well, cash float, input VAT. Input VAT have to be paid within a year. And then in terms of liabilities, we've got your non-current liabilities, which also is similar to your non-current assets. The difference is that now in terms of the non-current liabilities, we are referring to those long-term debt where you get to owe people for a longer period and you're gonna repay them over a number of years. If you go and buy your company building by using a debt, so therefore we're going to have a long-term debt, so or you're going to have a mortgage loan if you actually mortgage the property. If you didn't actually mortgage the property, you just took a long-term loan, so therefore it will be classified within the non-current liabilities. Normally in the non-current liabilities, you'll always find one line item within most of the business, which is either the long-term loan or mortgage loan. Then we're going to have our current liabilities, those short-term credit that we actually took to cover some small expenses of the business as we continue our business operation, such as short-term loans. For example, if you are short in terms of stock, you actually want to supplement the stock of the business so that the business can continue to run, you're going to go and take a short credit and buy those assets, and then once you generate revenue, you're going to pay those. So I see you have raised your hand. You're asking if there are any other expense you can think of that are not on the list. Okay, other expense that I can think of that are not on the list. Let me see the one on the list. Uh, A majority of them, I think they are listed here. Packaging, material, stationery, fuel. Okay, let's see if there are any outside of this list that I can think of. Okay, another one that can fall within income, but the thing is this one is not a physically, but it can fall within the income will be a discount received when you're actually buying something and you receive discount. Discount received is actually you saving money from instead of going to pay 10,000, they tell you that pay 7,000, so you actually get to save 3,000. So that will be the discount received. So it will actually have to be shown within the income. Same applies to our expenses. So our expenses, if you allow discount within your business when you're operating to say that no, instead of actually paying me 10,000 for this product, I'll sell it to you for 7,000. So you're actually giving the person the discount of 3,000. So it's one of an expense. It's an expense to you because now you didn't actually generate that money. You actually lost 3,000. So therefore, under expense, you'll have to show a discount allowed of 3,000. So it will become classified as an account under the expense. And then under capital, in terms of the real type world or the real statement, because this is just the basic. So under capital, we're going to have share capital. Under equity, in terms of owner's equity, under capital, we're going to have share capital, ordinary share capital. Ordinary share capital are those people that invest into the company and buy ordinary stock where they get to receive dividends. So these are the people that get to control the business. And then also I've got preference shares holder. Preference shareholders are people who buys preference share from the company. It's also part of capital, share capital of the company. But these kind of people, they do not get to control in how the business operate, or they're not involved in the business operation. Their only aim of contributing or buying or putting money in the business is just to get to receive the share of profit, and also to boost their investment profile. So they fall within the capital, we call them preference share capital. And once the company makes profit, they are also the first preferred to be paid dividends before the ordinary shareholders. So if the company makes profit and they declare dividends, these are the first people to be declared. Retained earning also falls within capital. So these are one of the things that will fall within the what? Capital. In terms of assets, things that is not mentioned there, I can see we've got land, building, machinery, equipment, we've got furniture, vehicle. One of the non-current assets that I can think of that is not there, what would be the okay, things such as your, but it falls within furniture, your computers, equipment. Your computer will fall within equipment, so it's gonna form part of that. But in accounting, we refer them as what we call property, plant, and equipment. So it is inclusive of the furniture of the company, your your computers, all of these, your printing machineries, these will all fall within the property, plant, and equipment. And then if there is a machinery will be separated under your property, plant, and equipment because of the way it will be classified. If it is used for production, therefore it will have to be recorded separately. But if it's we're talking about a machinery such as a printing machine, it will fall within the property, plant, and equipment. Other types of current assets that are not listed here will be short-term investment that the company can make. We've got trade inventory, trade receivable, petty cash, cash flow. So bank account also fall within current assets. So this is one of the type of assets that you also need to put in. And then current liabilities. Okay, we've got bank overdraft, trade payable, short-term notes, output VAT, and there is an item called note payable, but it also falls within current liability, the same as short-term loans. The terminology of note payable, it's when the company actually get to give out loan under its own terms. Instead of actually going to borrow from the bank, the company will say that we are raising money through a form of a debt, which is notes. Each note is worth 1,000. We actually need 10,000, meaning that they will be selling 10 notes for 1,000 each. When you buy the notes, we'll pay you interest of 5%. So even the interest that the company will actually pay, they will detect what interest they want to pay. And once you buy that, those kind of notes, the company will get to owe you. So it becomes what we call notes payable. So therefore, meaning that the company will therefore be paying interest, and those interests are fixed. They don't pay you interest plus the amount that you borrowed them. They only pay interest for a certain period. If they tell that they will pay interest for 3 years and then give you your money back after 3 years, that's what the company is going to do. It's gonna pay interest for 3 years, and then later on they actually do what? Pay you back your full amount, and therefore they don't get to owe you. So that's what we call a note payable. So it's also, we also have got long-term part of non-current liabilities like that, which we call them bonds notes or debentures. They are similar to note payables. So but those one are long-term. Those are when companies want money looking like 50 million, so therefore they will raise those kind of money under their own term to say that we have got bond notes. Each note is worth 10,000, and then we're actually going to sell 10, which for example is gonna come back to somewhere around 1 million. So meaning that's the amount that we actually want to raise. So we'll pay you back your 1 million in 5 years time, and then we'll therefore pay you 5% interest each and every year until we repay you back your 5 million. So that's another type of a non-current liability. But under for this lesson and for this current level of study, I don't think that we're gonna be covering that, but it's just one type of an example that I can bring up to you. So do you have got any other question? Yes, I'm going to explain more in terms of the transaction effect on the accounting equation in the next lesson. Yes, I'm going to explain that. That's where we're gonna continue or start off at. So here I just only explain the B to say that oh okay, there is still more. Yeah, I just explained to say that let me just quickly go back. In my laptop it's actually freezing. I get there is a lot of data that it's currently processing, or my memory is running low. So as I was still busy explaining, I'm going to explain more in terms of the transaction effect. So meaning that under the transaction effects, I'm going to explain in terms of once you record an item, how do you actually get to record an item within the accounting equation, and therefore transfer it from the accounting equation to your other elements of other elements within your financial recording system. Because the first one, it will be your accounting equation, and from your accounting equation you learn a new concept of how the accounting equation gets to be divided, or how do you get to put account within the accounting equation. Remember, we've got our cash, inventory, these are type of accounts. When we record this, how do we show that this is an increase, how do we show that this is a decrease? And then but at the end of the lesson, we just need to make sure that